Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites jugglingdynamite.com and venablepark.com. Welcome back to the show, Danielle.
Hey, thank you, Jim.
And happy March.
Yes, and unbelievable. Spring is almost sprung, thank goodness.
And yet, here on the West Coast, we're getting wave after wave of snowstorm. Hard to believe it's March.
Yeah, rough McGruff, I know. I've been watching that.
Danielle, Canada expects no economic growth over the next 6 to 9 months. What will that mean for interest rates and people struggling to make their mortgage payments?
Yeah, so you're right, the Canadian GDP update that came out this week shows zero growth in the fourth quarter, which was worse than the Bank of Canada had forecast. They'd been expecting a 1.3% annualized rate in Q4. Now, they're hoping that things pick up a bit in the first quarter, but these people tend to be overly optimistic in their forecasts on GDP growth. That's pretty typical. And it was interesting. It was slowing inventory accumulation because, there's a lot of high inventories and a lot of goods in the world at the moment and in warehouses and storage, and we've talked about that before. So when you get that amount of backlog or excess capacity in stores, you tend to see less orders going out, and that's happening now in terms of wholesale orders. There was also a decline in business investment in machinery, equipment. So those are, if you think about the drivers of the economy, you've got the consumer and you've got the business sector. Both of those were wobbly coming into 2023, and you only really have the government spending in the equation driving any growth. So what it really means in the near term is that I think the Bank of Canada will continue to be on hold, as it said at the December meeting that it had, it did a hike, and the policy rate is now at 4.5. And they had said they would, wait and see because they are aware that there's these multi-quarter lags of the hiking and how long it takes for these monetary moves to transmit through the economy. So they are not expected to do anything further on the short end rates on March the 8th, their next meeting. However, it's very interesting because inflation has remained stubbornly in the system. It's a lagging indicator. We've mentioned that many times. But, they're still looking at the recent CPI in Canada was 5.9% annualized. They're looking for it to be more like 2. So there's this kind of I think there's really been a sort of jaw drop, unbelievable aspect to watching central banks in the last year. No one expected them to move from 0 to 0.25 up into 5%. Within a year. I mean, no one thought that was on the cards. And I think that as this has continued, as they've kept hiking and kept talking hawkishly, regardless of the downturn in all these different sectors of the economy, I think the market is really starting to believe them when they say the bond market in particular has sold off, dramatically now. It's actually been in a down cycle for 30 months, the Treasury bond market. So that's the longest drawdown in history, period, full stop. We're facing that the reality is that 21 central banks have been tightening worldwide, and the money supply has gone negative in all of those economies at the same time, which we've never seen before in history. So rate shock is sort of an understatement for what the world is going through right now. And the bond market is sort of thinking, oh my God, these guys are crazy. So maybe they are going to keep hiking. So it's interesting, although there's no expected increase for the March 8th meeting, the bond market has still penciled in the potential for another quarter-point hike by the fall, even in Canada, even in the fact that Canadian housing is crashing by all accounts, and the projections are that it could fall another 15 or 20% over the next year, and all of the knock-on effects that that's having, right, in terms of strife in the consumer sector, in terms of drop in the amount of sales that are taking place and in the prices of those that are selling. So all of that carnage is building up, and yet the bond market is saying, well, maybe they are going to hike some more in the fall if they don't get this inflation data to fall quickly enough or to the pace that they're wanting. So you've got this really mayhem going on all over the place. The Canadian dollar has weakened, though, since last June, and I think that's again a reflection of the fact that the U.S. Fed has been, is out in front and expected to hike potentially another 3 times in 23. Their housing market is also coming apart at the seams, but not they weren't starting from such a crazy level as we were in terms of the overvaluations to begin with, and in terms of the household debt to GDP and household debt to disposable income. We were much worse coming into this than the U.S. this time. And so the Bank of Canada is on hold right now. We'll wait and see. Remember, though, that all of the tightening that the central banks do is at the very front end overnight rate. And the bond market ultimately is the one that prices the expectations for what's coming in the future. And even though that, the stock market peaked on February the 2nd and has fallen over the last month, bonds in Canada, the yields have not made new highs since last October. So I still am in the working sort of thesis here that rates in Canada are not likely to go a lot higher because the economic impact has been so negative. And we know that recessions always kill inflation eventually, even though it takes some time. So the base case that we have here is that the short rates in Canada have likely peaked, or maybe a slightly, another 0.25 by the fall, but ultimately that the central bank here is on hold. The Canadian dollar is weak in reflection of that relative to the U.S. dollar because of that reality that people can get, higher rates right now in America than Canada. And you're seeing that, the Canada 3-month Treasury yield is 4.55 right now, and the 1 year is 4.72. If you look that's the highest since 2007. It's mind-boggling compared to where we were a year ago. But if you look at U.S. rates, the 6-month rate there is 5.16. Actually, all rates on the U.S. Treasury curve from 4 months to 1 year in America are above 5% right now. So again, something we haven't seen in so many years. So catastrophic for debtors, right? Really bad for not just households and mortgages. There's a ton of private debt coming up for renewal in the next 12 months. There's a lot of corporations that are having trouble making their payments now. Defaults are spiking, both in auto loans, in corporate debt. It's really quite awesome to behold what's going on here. E-commerce sales were negative year over year already, Jim, in the recent data. We've only seen that happen one other time in 2008 because, everyone's so tech-centric and, they'll spend on laptops and phones and, technology often for work purposes or just connectivity purposes. So when you see e-commerce retail sales go negative, you know that we're in a very negative shock to the household sector. So all of that to say that I think that the Canadian economy is going to do poorly in 2023, especially as the housing market continues to unravel, and that will likely keep the central bank on the sidelines and likely see a rally in Canadian bonds, the high investment grade government bonds, as we go through this year, as there isn't many more hikes as the Bank of Canada stays on hold. And then at some point within months after they've been on hold, you'll likely to see them cut again. But at this point, this is the point that I was making before. Right now, we've never seen more hawkish central banks in, more than a decade, and they are presently saying they don't intend to cut at all in 2023. So there won't be any short-term relief for anyone with variable rate debt, for example.
Danielle, people are wondering why the interest on their savings accounts isn't keeping up with the interest rate hikes, especially what people are paying on their mortgages. We recall back in the 80s when some savings accounts paid up to 19% when inflation was running nuts. How come we don't see that now?
Yeah, so it's very interesting, isn't it? I mean, banks are always very, that spread is how they make the bulk of their earnings, that and on the financial products and securities that they issue. But basically we've been in this time when people got so used to making nothing on money in the bank. I mean, it was just the highway robbery of incentives towards savings. It's been such a perverse episode in our history to go through this time when, my kids, when they opened savings accounts 10 years ago, were used to making nothing. And now they're actually getting interest on their savings. This is something they've never experienced before. Now, having said that, you can't keep it, as you've just mentioned, in just short-term savings accounts at the bank because they haven't moved those rates up in reflection of this new dynamic. They're now, making the fat spreads. And the reason I think is that they have this kind of, captive audience of people who have money, the ones that do have savings, and they're just sort of, they've been placated for so long or put to sleep, anesthetized in the expectation of any kind of yield on their money in the bank. And, the banks are pretty flush with deposits right now. They don't have a lot of incentive or competition amongst each other. Now, some of the B players are, looking for deposits, and they offer these short-term incentives, a 6-month perk rate and that sort of thing. Now, the investment savings deposits, they call them the TDISA, high yield investment savings. Each of the banks has those products, and those products are yielding more than 4% today, more than 4.5%, certainly. So there is a place that you can put cash, but you do have to make some effort to do it. You're not going to just make the yield just by having it in pure cash in your bank, unfortunately. And I don't know if, that should have changed by now, but again, they're very slow to make the move. They're making the fat spreads on their deposits versus the loans they're making on all the variable rate debt that's gone up significantly. But I think that banks are also, getting squeezed in terms of they see that they're making a lot lower amount of volume loans here. The loan volume has really dried up, and that transactional aspect of their revenue is really taken a hit. Not only that, but new issues are really down because security markets have been so extremely volatile. So banks are really taking a hit on all fronts and starting to set aside more loan loss provisions. Loan losses that aren't recouped end up being bad debts, which hit earnings, and that's sort of the typical cycle we see in a recessionary period. And I think the Canadian banks are trying to sort of keep their margins wherever they can because they see that there's a lot of storm clouds in the mix.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, downtown small businesses across Canada are complaining about the lack of business because people aren't going back to their offices, or if they are, they're only going back for a few days a week. Specifically here in British Columbia, Victoria, which is the capital of the province and business and government oriented, they said they're missing some 3,000 people who used to flood the downtown every day. And in British Columbia now, if you work for the government, you can work from anywhere in the province as long as the job gets done.
Yeah. So this is a phenomenon that we're seeing across the real estate sector in all of the major cities. Toronto has an incredible increase in the amount of vacancies in the downtown sector in the commercial space. So that was something that was sort of starting pre-pandemic. but it's really picked up steam. As you say, the hybrid work models where people are not going into a centralized office, at least not 5 days a week. And in this environment where revenues are in decline at so many companies because of the consumer retrenchment, because of the spike in borrowing costs and all the inflationary impulses that have made the stress and reduced the amount of spending that's going on in the economy, all that to say that you're seeing a lot of pressure on the cost structure. So companies are figuring out ways to be very nimble, very lean, how to cut overhead, whether that's automation of some of the workforce, whether that's hybrid work models. They're very keen on cutting costs. And there was this massive overbuild of the real estate sector in general, massive overinvestment in real estate over the last decade when you were in the zero rate environment that was created by all the central bank shenanigans and the massive amounts of debt that were being thrown around, really made a lot of overbuilding in some of these particular sectors. And we've talked about this before, but the private equity people were really just guns a-blazing, taking in endless amounts of money and pouring it into the real estate space, in particular things like the commercial real estate space. So there's been a massive overbuild during the bubble that is now, been compounded by the COVID and the shift to hybrid work models, the aging workforce, the online move. All of this is really coming up in terms of meeting less in terms of demand, meeting this oversupply. So we've really got a great imbalance in the market. It's showing up in the financial products that are allocated in this area as well. We've seen many of the larger private equity funds in the real estate space actually gate withdrawals lately in the last year, where they're saying to their investors, oh, by the way, you can't take your money out right now. We're going to wait because we don't want to be forced to sell properties at an inopportune time. Now, Blackstone actually defaulted on one of their bonds, Jim, in the last week, which is, I think the thin edge of the wedge here. So what you're probably going to see is a continuation of oversupply, properties coming up for lease. A lot of people that had commercial mortgages are finding it's no longer at all feasible to continue to hold the properties and make the payments at the new rates as mortgages come up for renewal. And so they're looking to sell. And once you get that, combination of more properties coming on the market, rising vacancies, lots of for lease property and space, you get the push down on rents. So at the same time in the residential sector, you're seeing that I was writing about this recently on the blog. There was like a 59% increase in the amount of investors of residential properties looking to kick their tenants out so that they could take the properties back under the auspices of needing it for their own use, for example, and then hoping to re-rent at much higher rates than they can get from their current tenants because of the certain restrictions on how much rents can be raised in a year. So there's this push of people trying to get owners in distress because of the higher rate cycle, and now trying to kick out tenants to re-rent at higher rates, and it's just really chaos in the sector. A lot of sales, people in bookend sales of, closing one deal to buy another are having problems where one falls through. I mean, it is just chaos, and I think it's going to get worse from here. Because as I say, a lot of the rate hiking that's happened has yet to hit the economy. Not everybody had a variable rate mortgage. Only about 30 or 40% of the mortgages have floated up in the last year, and the rest of them were all coming up for renewal at staggered terms and facing these, mind-boggling increases in the cost of their debt. So as I say, it's a very stressful time to be levered in any kind of investment market. We're seeing the stock market wobble again. The Dow is now negative year to date. The TSX is up a bit, but it's fallen again over the last month. So I think we're in risk off again here. The only caveat potentially is we could see some strength maybe even into April because of it's the third year of the presidential cycle, and sometimes you would see strength even last into April. But after that, it's very murky. There's a ton of risk, and there's no good reason for people to be in super risky assets or buying levered properties and all that with rates where they are, when they can earn nearly 5% on these, like I say, cash-like deposits. So there is certainly an alternative to crazy amounts of risk right now. You know, the yield on the S&P is only 1.7% if you're holding that units of the U.S. stock market, and you can get, as I say, 5% holding a U.S. Treasury, a short-term U.S. Treasury. And in Canada, the TSX yield is like 2.9%, and you can get, you know, almost 5% in again, very low-risk money in terms of short-term bonds and that sort of thing. So it's really a fundamentally different world than it was a year ago, and I think that we should all be aware of the fact that the trends are likely to filter through and cause more of what we've seen recently over the next year.
There's a trend. I saw an article on your blog about rooftop power. Everybody gets some solar panels up there, and I've looked down from my high rise, and I see all these rooftops facing south that could be collecting energy on the rare sunny days we have here in British Columbia. And I have what I call a solar balcony. I have so many little lights and gadgets that run off solar power that on a sunny day, they run well into the night. On a cloudy day, they don't even come on. So I don't know if it's much of an alternative in a cloudy, rainy place like British Columbia, but for the prairies, at least you have sunshine so many days.
Absolutely. You know, the Tesla 2023 Investor Day was yesterday. I put a clip of that on the blog for all the people that are interested, because this is literally the transition that I see as a major help to the problems that we currently have. So what do we need to do in this environment? We need to get costs down. We need to figure out ways for people to live more efficiently, to waste less and save more, right? We have to rebuild the foundations of the economy, of the households, of the business sector, because we've been through this decade where money was worthless and everybody did all these crazy things, and it was very destructive. Some of the good that came out of that was some tech companies did actually get some dollars for startups and innovative things, which are now coming to fruition. And the renewable energy space is certainly one of those areas that benefited from getting capital during this era and was able to actually come up with some incredibly useful technology. And that is in a massive growth rate. You know, it's not only an S-curve adoption, it's if you look at the amount of sales that are going on in autos, they're all in decline except for electric cars. If you look at, you know, the spreading out of solar, wind, and battery. So in actually, you know, when you mention about Vancouver, the Solutions Project out of Stanford has done blueprints for Vancouver and British Columbia, just like all the major cities in the world and all of the provinces, to show that you absolutely can become self-sustaining in terms of renewable energy. And I think the biggest point that people miss, and that's why there's so much misinformation and wrong information going on in this sector, but the thing that people miss is that renewable power transitioning to that wastes so much less than the current fossil fuel driven system that you don't actually have to replace the power kilowatt per kilowatt for the existing system. You need about 50 or 60% of the power currently being generated in order to be just as efficient in solar and wind. And you do need backup, of course, and storage, but there's so much going on in terms of the innovation and development in all kinds of battery types, not just lithium-ion batteries, but all kinds. So there's that huge advantage coming where, we can get it so that everyone is collecting. What should we do with all these buildings that no one wants to use as offices anymore? Well, certainly to the extent that they can be south-facing or capture passive energy, there's something to turn a non-productive property into something that's at least producing energy and can get revenue by selling that to the grid and all sorts of things. So I think that a lot of our buildings that have become superfluous will be now spots where we can add in these mini power plants. And yes, it'll reduce costs and increase revenue and cut out waste, and that's all the right themes right now.
People complain they'd like to buy an electric car, but they just can't afford one. In Europe, Volkswagen has rolled out an electric car that only costs $10,000. How can they do it so cheaply?
Yeah, well, actually, they developed that product for China, right? Because they wanted to have something accessible for that market. But yes, it's relatively easy. It's basically, now that battery technology is really driving, it's like a skateboard approach, and all these companies can just put the battery as the base and put whatever little top on it they want, whether it's exotic to, the most economical or basic car. So the technology is there. 12 years ago, Tesla released the patents to the open source, right? So that everyone could, the intention was literally to launch this race for electric vehicles to get competitors into the space. And boy, they resisted. The legacy car manufacturers did everything they could to resist and poo-poo and pretend. And now they're galloping to try and catch up. And so, yes, they're rolling out all kinds of different versions of it around the world. There's getting to be a lot of competition in this space, which is very healthy, and the price point has been falling dramatically. And that, of course, is what we've seen in, high-end technology from the very beginning of time, even with the most original or very first ICE engine cars. They were always very expensive at the outstart, only for the rich. And then as the technology proliferates, you see that the price comes down, efficiencies go up. The automation that Tesla's done in their factory is world leading in terms of encouraging other people that they can make make vehicles for a fraction of their prior cost with a fraction of the parts and all that. So yes, efficiency wise, it's a booming area and there's all kinds of upside there. But we have to make that transition. And right now we've got a lot of inventory of the wrong type of vehicle.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. If you have any questions for Danielle or any of our guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any